And what you're having is a cost of living crisis across the board that's going to be devastating for most working Americans, except the billionaire classes that own huge assets on cheap borrowing. I think they move us into tokenization of assets first, where you're obliged to register. Otherwise, there's fines, there's threats of prison. They'll write more laws that will permission more force. Governments have got too big and have stopped fearing.
You're watching Silver News Daily. Subscribe for more.
They told you silver was finished, that the rally was over, that a dull, sideways market meant the opportunity had passed. But they lied. Because behind the smokescreen of falling prices and manipulated charts, something far more sinister is unfolding. Right now, the global elite are preparing their final move, a calculated, cold-blooded plan to obliterate your wealth, seize your assets, and leave you with nothing but digital permission slips to exist. Hyperstagflation isn't just a buzzword anymore. It's here. The dollar is being dumped. The UK debt market is collapsing. And in the chaos, one asset is quietly being drained from the system. Physical silver. Francis Hunt has seen this script before, but this time, the ending is different. Because this time, they're not just targeting your money, they're targeting your freedom. Tokenization, biometric tracking, full-spectrum surveillance, all masked as financial innovation. But it's not innovation. It's confiscation. And silver? Silver is the one thing they can't control without first destroying it. That's why it's being artificially suppressed. That's why COMEX is leveraged to the teeth. That's why they're running out of time. So here's the real question. What happens when the suppression fails? When the middle class wakes up? When trillions flee dying fiat and the last refuge left is silver? Because when that moment comes, and it's coming fast, $2,000 silver won't be a prediction. It'll be a warning shot.
We've felt that there was going to be a dull period for a bit now, after we had a failed breakout. We got kind of excited for potential breakouts, and then it failed. This was at the back end of July month. And since then, we've expected a kind of a dull, sideways and down market. I just want to highlight a few things, and this is probably best done technically as well as ever. We are the chart guys, if we're anything, and particularly on precious metals, it's such a good tell. So I'll show you a little bit about where we've been and why I think things could get interesting. Before I go to the monthly chart, I'm just going to show you the weekly chart. You may recall, and we were on your channel, I remember this quite specifically, and we highlighted this squeeze. And we throw a few catchphrases so people remember. We said once, that was the 2000 level is the blue line, twice, 3 times, and then a lady. That's your run. And we said you're going to run to 29,3000. That's the blue 3000 line, by the way. And then the one thing I want to highlight that happened after that, and for that I'll even take us down to the daily, is that we actually had fundamental events occur. Donald Trump went super aggressive with the tariffs in April, and it looked like he was picking a fight with everybody. You're on 30%, you're on 30%, you're going to be 100%, da-da-da-da-da, and it was quite wild. It was a bit like a drunk barroom brawler who's taking on all comers and swinging from the bleachers a little bit. Not to mischaracterize him, but it was a little bit out there. And we got this panic in April on the US debt markets. The rate shot up. The dollar actually went down, which is a key point in the warning to those dollar milkshake guys that rates can go up without the dollar going up with it. It can actually do the opposite. And we got this surge all the way up that went to a localized high of 3,500. And it's very interesting, that number, because it's obviously the round number. It's a bit of a derivative significance in terms of that for the derivative number. It's also closer to 4,000 because it was 3,500 and a fractal of a cent. So it was slightly closer to 4,000 than it was to the original 3,000. So that would have put the frighteners on a lot of the system coordinators and handlers. And since then, we overperformed a little bit because our target, as we mentioned, she was 29,300. So we got a little bit of an overperformance. And now we've been hanging tough at a couple of levels. Now I'm going to take you to the monthly And I'm a little bit OCD when it comes to charts and noticing things, particularly in the precious metals game. So I'm going to just turn all my lights off there so that you can just see the candles. And when we were going up, we went out on YouTube. You can go and have a look. Precious metals might come down or pull back or go sideways and not do much positive and be a bit of a sell-off for a short, medium term. By the way, still macro, the biggest bulls, gold and silver out there. However, just made that 3,000, got a super surge blow-off run to touch the 3.5 and since down. Here's a really interesting thing, and I'd like everybody to...
Over the last few months, silver's price action has lulled investors into a false sense of security. A failed breakout in July, followed by a slow grind downward, has left many wondering if the silver story is over. Headlines call it a healthy correction. Analysts point to profit-taking. And the mainstream financial media has already shifted its focus back to tech stocks. But here's what they're not telling you. This sell-off isn't natural. It's deliberate. And it's the calm before a very calculated storm. Right now, silver is trading around $30 an ounce, down from its April peak of $34. On the surface, that's a minor pullback. But beneath the surface, everything is shifting. COMEX futures are seeing reduced open interest. Speculative long positions are drying up. Retail enthusiasm is being drained. And the short-term technicals? They've turned decisively bearish, with silver breaking down from a key wedge pattern. But that's exactly the setup smart money waits for. The moment retail walks away in frustration, the stage is cleared for a massive move, one that leaves the doubters behind. Let's be absolutely clear, this is not a reversal of the bull market. It's a reset, a strategic moment of weakness designed to shake out weak hands before the real breakout begins. Even the experts are split. Saxo Bank warns of a drop to $28, but Heraeus expects a rebound to $35 within months. That's not noise, it's divergence. And divergence always precedes volatility. Silver isn't dead. It's crouching, coiled like a spring. And while the price may look sleepy, the fundamentals beneath it have never been louder. Because this pullback isn't driven by demand, it's driven by fear. And the moment that fear flips back to greed, the suppressed energy in this market will explode.
Do this with me. I've just done it. So watch the close. I'm going to put the pink box around the close. Watch the numbers that come up here. So here's April for us when we made 3.5. Do you see the number 3288? 3,288. We can forget the 3 grand. We know it's 3 grand. So you've got 288. We can even forget the 2 if we want to. It's 88. 2 fat lazies. There we go. 89. The close on the month after April, May month, 89. The close on the month after that, 303. So we've got 88, 288, 289, 303. Then the close in July. So we've done quite a few months here. So let's start again. April, May, June, July. What was the close in July? 3290. So let's just recap. 288, 289, 303, and 290. So the 303 is $15 from the lowest one, 288. So we've closed 1 month, 2 months. Let's do it with a pink so everyone can count with me. 1 month, 2 months, 3 months, 4 months in a row within $15. 88, 89, 90, and 303. And that's a slight concern for me. And remember, I remind you that derivatives, month ends matter because of derivatives. And there quite clearly is wick selling in the second half of the month. Now, at one point in the early part of this month, this was all a green candle. And I said, don't get excited. It could come back down. Do you see how we're now the 19th? I don't know if you can see top right there, the date, 19th of August. So the trading days left of this week are far less. We've got another weekend to come to. There'll probably be 2 more weekends. So actually, we've only probably got maybe, I don't want to speak out of turn. I haven't counted them, but 10 more trading days. And this wick has come all the way back down, and we're now at 317. So the highest was 303. So this to me is a little bit of, if I just put in the current closes in a box, that's the current closes for gold. How narrow is that? And then I say, this one's coming on back down to, so it's an observation. And it points to these selling wicks are rejections for me. And they're all on the high side more recently. So this one over here, you also had a test to the downside and you came back up. So it was at least floor and ceiling. This is all about being resisted up top and coming down. Now, what goes for gold leans on silver even harder, because if we get a sell-off in gold, as we know, typically we get a little bit of a higher beta sell-off in silver. That means silver can retrace. So we've been not trading long after being aggressively trading long since this period here, when we were telling you about once, twice, three times, and then the lady, which was a great period where actually in monthly terms you had 1, 2, 3, call it 4, 5, 6, 7, 8 months in a row before you had 2 negative ones, and then you had another 1, 2, 3, 4 green ones. So you had 8, 2, and 4. So you had 12 green months, and you only had to sit through 2 down months, and one of them was incredibly small as a red body. So that period, that overperformance period with that final surge with the Trump tariffs, has made gold.
While the charts may show weakness, silver's industrial demand tells a story of unstoppable strength. This isn't the 1970s. Silver isn't just a hedge anymore. It's the metal the modern world can't function without. Every new solar panel, every electric vehicle, every AI server rack that powers your apps and runs your data, all of them consume silver, and not in small amounts. In 2024 alone, over 710 million ounces were devoured by industrial applications. That's an 8% year-over-year increase. But here's the catch. This isn't demand you can dial back when prices rise. This is structural. It's baked in. Take solar. It's no longer just an environmentalist fantasy. It's a global mandate. Governments around the world are locking in aggressive carbon targets, and the fastest way to hit them is by scaling solar infrastructure. That means silver, hundreds of millions of ounces of it, used in every single high-efficiency photovoltaic cell. And with solar adoption exploding across China, India, and the EU, the metal's offtake isn't slowing, it's accelerating. Bloomberg NEF confirms that global solar capacity additions grew by 24% in 2024. Metals Focus projects that by 2026, solar alone will require over 250 million ounces of silver per year. That's a quarter of all global supply, vanished into panels that won't be recycled for decades. And it doesn't stop at solar. Electric vehicles are pushing the limits of conductivity. From battery management systems to onboard electronics, every EV contains significantly more silver than a gas-powered car. China's EV production jumped 15% in 2024, and that's just the beginning. Analysts are now warning that the rise of inductive charging, autonomous systems, and advanced powertrains will only push that silver load higher. We're also seeing demand from AI data centers and 5G infrastructure, sectors that barely registered in silver demand forecasts just 5 years ago. So ask yourself this: how can silver be in decline when its real-world demand is surging? The answer is, it can't. The disconnect between industrial necessity and short-term pricing isn't sustainable. And when the investment world finally catches up to what the industrial world already knows, silver won't just rise. It'll have to reprice entirely.
And silver a little bit overcooked. You and I have run a marathon. We've gobbled 3 pizzas and had 5 beers each. We're not about ready to get off our couch and go run another marathon. So there's a bit of congestion there. There's a little bit of bloat going on. And that's kind of how we've characterized the gold market. And I think we're going to turn out being correct. And we've got a little bit of selling. And in fact, this close could not only pass 303, it could pass 3290, 3289, 3288, and it could actually close lower, and you could have your triggering event. So typically our tactical people trade shooting stars is they have a stop at the top of the shooting star and they short the bottom. Short the bottom. Now you've actually got quite a few to choose from, but this one is going to be the smallest one. You went the least way up. you could short there. Now, that would be tactical trading. I'm not going to do that, and people aren't going to like hearing that. But if we have a crisis of some form, I'm mentioning the UK debt markets are deeply disorderly and the rates are looking like they're due to spike. So the UK could bully its way to the front of the queue and you could have a bit of a contagion on the debt side. And normally, I would say long run, it's very bullish gold, because people will drop treasuries for gold. But initially, when you're in that disinflationary vibe of panic, people sell everything that's not nailed down, and that could see gold come off. So we are slightly more concerned for gold and have been that way for 3 or 4 odd weeks. And currently the market is giving it to us exactly like that. If I take us down to the lower time frames and just put back on our eye, you'll see our technical. This is a wedge that we're falling out the bottom. And again, that's a bit of a knockback candle, and you're getting another knockback, and actually you're slipping out of the bottom of that falling wedge to the downside at the moment. And that's going to have a negative effect on silver. So XAG USD. As we were talking, I was apologizing for the noise, and those were alerts being pinged on silver. And what do we have? We have silver on a downside break. I'll again just hide all the works. You can see a little bit circumspect after a move up to the high over there and the sell-off. So that's, again, the day down to indifferent flat days. We've had 2 days down and 2 nothing days. So there is a bit of heaviness, despite the fact that fundamentally, I think silver is probably running low on supply. But the paper markets are illustrating.
There's one critical problem no one in the mainstream is talking about. The world is running out of silver. Not in some distant theoretical future, but right now. While the industrial demand rockets to all-time highs, supply is failing to keep up. And that's not hyperbole. It's a structural collapse in the making. Global mine production in 2024 came in at just 820 million ounces. That's down from previous years, and nowhere near enough to meet the 1.2 billion ounces of total demand. That's a shortfall of nearly 200 million ounces. In a market this small, that's catastrophic. You see, silver isn't like oil. We can't just drill more when the price spikes. Over 70% of the world's silver comes as a byproduct from mining other metals like copper, lead, and zinc. That means silver production doesn't respond to silver prices. It responds to the economics of completely different markets. So even as silver becomes more valuable, the supply doesn't magically appear. In fact, it's constrained by forces completely outside of silver's own fundamentals. And the mines that do focus on silver? They're under pressure too. Mexico, the world's largest silver producer, saw a 3% drop in output in 2024 due to labor disputes and tightening environmental regulations. New mine development takes years, sometimes a decade or more, and right now there are no major silver mines coming online at scale. The industry is simply not prepared for the demand tsunami that's already here. Above-ground stockpiles are being drained just as quickly. COMEX inventories are down 10% year-to-date. India's silver imports rose by 20% in 2024. And retail premiums on physical silver are rising again as mints and dealers scramble to keep up with orders. All of this points to one undeniable truth. There isn't enough silver to go around. Not for investors, not for solar manufacturers, not for automakers, and certainly not for central banks quietly accumulating in the shadows. So when the paper markets tell you silver is worth $30 an ounce, what they're really telling you is the price of a promise. Because if you want the real thing, the metal in your hand, not digits on a screen, you're paying a premium. You're waiting weeks. You're finding out just how thin the supply really is. And when that illusion breaks, when too many people ask for delivery at once, the system won't bend. It will break.
That there's a little bit of fear out there, a little bit more fear.
What kind of downside potential do you see in both gold and silver at the moment?
Okay, so let's go back to the boss, which is the king of the metals markets. I'll just pull up gold there, and I'll show you ranges which will give us an idea of degree. I threw a couple of boxes on this when I was discussing this. First of all, that is the 3,500 high and then the subsequent 3,120 low. That was our first reaction after that blow off top. That's one box. There's another more slightly inside the range box. That was the secondary high. Whoops, let's get a better color than yellow. Sorry for that. Let's go blue. That's what we were looking for. You've got a localized high and a localized low there. Now, it's a question of 3 degrees of badness. This could all end and you could come and you could maintain inside this range and just test a new low here. So that would be moderate down. Nobody's crying too much in terms of the long-standing precious metals stackers. That's maybe even just a small buying opportunity. They're not upset about that. You could get a deeper dip if I go the pink option, and then you could run that low and this low, localized low, and you could stay within the larger range, but not run the 3,120. And then there's the exceptional item, which would be, we have a real September, August, October crisis, say with the UK debt, and we have a choppy market and everything is being sold and there's mad panic, and we break that low. I think we're going to probably remain in range unless we have an exceptional crisis, but I will highlight August last year, second half, was the carry trade unwind shock. And September, October are that period where a demand-destroying event, as we've referred, and you get that disinflationary assets crash, and that would probably include the stock market as well. People are getting a bit more circumspect about the pricing on the US stock market. You could probably have corrections September.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes. Real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
For decades, the paper-silver market has been used to control perception. Prices rise, and suddenly, tens of thousands of contracts flood into COMEX. Paper promises backed by nothing more than confidence. But that confidence is wearing thin. Right now, we're staring down one of the most leveraged setups in modern market history. For every real ounce of silver in COMEX vaults, there are 28 paper claims. That's not a market. It's a time bomb. Think about it. As of August, there are just 290 million ounces of silver in COMEX inventories. That's already down 10% since January. Of that, only a fraction is actually available for immediate delivery. The rest is eligible, meaning it's theoretically there, but not necessarily accessible. Meanwhile, delivery requests are surging. COMEX deliveries jumped 15% in Q2 alone, and physical withdrawals are becoming a trend, not a fluke. Asia is buying. Retail investors are stacking. Sovereign wealth funds are quietly repositioning. All of them are pulling real metal out of the system. Why? Because they don't trust the paper, and they're right not to. If even 4% of open interest demanded delivery, the entire system would freeze. COMEX cannot meet that level of redemption. The math doesn't work. This isn't speculation. It's structural fragility. And everyone close to the system knows it. That's why bullion banks are short the market by hundreds of millions of ounces. That's why premiums on physical silver remain elevated even when spot prices drop. That's why silver ETFs are bleeding inventory. The message is loud and clear. Paper silver is not silver. So here's the truth. What you're seeing on the price chart is fiction. It's not a reflection of true supply and demand. It's a managed perception, held together by a thin layer of leverage, confidence, and hope. But markets built on hope are fragile. And when the day comes, that trust evaporates. When just a sliver of participants demand metal instead of contracts, The paper price won't just rise. It will disconnect completely. Because the real price of silver isn't what COMEX says it is. It's what people are willing to pay when there's none left.
And as I mentioned, they have the same malaise as the US without the hegemon status, as you know. And what we're seeing from our side here is that this is the 30-year. In fact, I will choose the 40-year. Maybe it's a little bit longer term. I think it's almost a better example. And I may already have it. We're going to put a structure, a draw on here and highlight how the rates are going higher. And what that actually means is, and the same applies to the US, but it's actually, I think the UK is going to become the headline of world news on this basis, on debt, higher rates. That's going to crash housing. It's going to put a lot of pressure on housing. It's going to put a lot of pressure on any corporation that's borrowing, any individual that's borrowing. Anybody who needs to buy housing is going to find much more expensive borrowing costs, or vehicles for that matter, which is an asset class that's got a bit overexposed to lending in the UK as well as in the US. And the same principles are holding for the US. The UK is pushing to the front of the queue now with their rates, with some very specific issues to them. They don't manufacture anything. The services economy that they used to have has contracted immensely. Europe's wanting some of their own City of London vibes, so that they kind of got fragmented there. They've pursued a very socialist agenda. They brought in a lot of immigrants at great costs, and they're housing them in hotels, etc., as a percentage of the population. Various other things, as well as, all the usual boondoggle industries that the politicians seem to get rewarded for overspending on. So they've had a spell of hyper over expenditure, and now they're facing much higher rates. And that's going to do real damage to them in the same way as the US. But they're just pushed to the front of the queue where the US was leading there. So if we just go to the US, I'm not sure you have a 40-year instrument, but you probably have a 30-year, so we'll go there. It's true of them all. It's just more apparent that it's going up in the UK.
While the headlines obsess
but in the
over
long
jobs
run,
numbers and
this
GDP
also goes up,
revisions,
the 30-year.
real story
And you
is
can see how
unfolding in
close
your
you are
wallet.
to highs. I'll just take some of
Inflation
these
isn't cooling,
drawings
it's
off.
calcifying.
You're not that
And
far
beneath the
off
surface, the
all-time
dollar is
highs.
quietly
If
bleeding
we
out.
take what is your
As of
highest
September
close,
2025,
I think the highest
the
close
US
is
dollar
there
index is
or
down
there. That was
7%
probably the
year-to-date.
highest close.
The Mexican peso is
That's
up
where
11%.
you're trading right now. You're
The Russian ruble,
3.4%
despite
off
sanctions,
your
is
highest
up over
close on your
40%.
long-term debt instrument.
This
It's
isn't a
not
blip.
very
It's a
big move.
shift.
You're at
The world is walking away
4.909.
from the
If you
dollar,
go to
and every step they take sends silver higher.
5.08,
The Federal
so
Reserve is trapped.
4.909 to
Inflation is still running at
5.08. You're just
3.2%,
through
but they're
5, you're
holding
not
rates steady
5.1
at
even.
4.75 to 5%.
It's very easy for that to happen.
Why? Because the moment
and
they raise
this little
rates, the
structure
debt bomb
will
explodes.
see you follow the United
So they
Kingdom.
sit and stall and pretend they're in control. Meanwhile, the U.S. national debt has crossed $35 trillion. The fiscal deficit is now permanent, and the only way out is the oldest trick in the book. Debase the currency, inflate the debt away, and hope nobody notices. But people are noticing. That's why central banks are piling into gold and silver. That's why Russia and China are buying hard assets with both hands. That's why emerging markets are dumping dollars in favor of commodities and bilateral trade. They see what's coming. They know that the dollar's dominance is not immortal, it's conditional, and those conditions are breaking down. For silver, this is rocket fuel. Every tick down in the dollar makes it cheaper for foreign buyers to scoop up metal. Every whisper of currency debasement sends investors scrambling for hedges. But unlike gold, silver still trades at a steep discount to its historical value. It's the underdog, the laggard, the one asset that hasn't yet caught up to the new monetary reality. So when you hear about dollar weakness, don't just think of foreign exchange rates. Think of it as purchasing power theft, a hidden tax on everything you own. And the best defense against that tax? It's not a digital ledger. It's not a central bank promise. It's a tangible, uninflatable asset, one with 5,000 years of monetary credibility and a future that's only just beginning to be priced in.
That's a little squeeze for further upside continuation. Yes, you're coming down now, but if you go up and break that, and this is all a bull market, and in terms of the yields, not on the bonds, the bonds are obviously doing the exact opposite, going down in value. So you're very close to all-time lows on debt valuation, and at the same time, the dollar has been the worst currency. I was actually just preparing some charts for some other work and a newsletter I was doing, and these might prove interesting for you. I want to show these off. This will just give you the top 22. I couldn't squeeze 25 on of currencies that the dollar has been performing against. So a lot of people saying, hey, our NASDAQ's at the all-time high. Okay, let's just have a look at this. You first had a 26.48 crash. So the melt up, people, that's not a melt up. Your melt up is when you do that and then crash, not when you have a crash and you return to the previous level. You've since put 7.65% on the previous level, which is the same as having walked across there, only you had a shocking drop in between and your volatility got really, really high. But if you look at how the dollar has performed, you know, you've underperformed the Thai baht by 2.5. The South African rand is a better investment by almost 3% than the dollar. The CNY, that's China, the Indian rupee is 3.2% better than the dollar. The Turkish lira, Elijah, is a 3.5%. I mean, that's a travesty token of destruction. The PLN, which is the Polish zloty, is 4% better. Now we start getting into the loonie, which is the CAD, your neighbor. I almost said Canada for the Canadians. The Egyptian pound is 4.5% a better currency than the dollar this year to date. The Australian dollar 5, New Zealand 6, Japanese yen 6.41. The pound is actually 7% better performer than Norwegian kroner, almost 10. Mexican peso is 11% outperforming the dollar. If you started this year and you converted all your dollars to pesos, never mind the interest rate you probably might have got if you put a call account on here, and you went down. So why am I laboring all the way through here? Well, you can see euro 11.1, Swedish 13.5. You're going to 14%. Brazilian real. These are emerging market currencies I'm talking about that have got 14% bigger today than the beginning of the year against the dollar. So 7.65% higher than this level. It's not a melt up. The ruble is 42% higher, by the way. So much for sanctions. Their currencies got stronger. They've got no debt and they're buying gold. It seems like a smart strategy to me. They're having less problems. They'll get more for it. The Hungarian forint is almost 15. So I'm over-laboring the point, but what we're actually saying is in dollar rebased terms, that 7.65% is a terrible performance. If you take the NASDAQ and other US investments, you are, whilst everyone's bragging and you should feel great, you're at all-time highs,
You've heard the term stagflation, but what's coming now isn't just stagnation and inflation. It's hyperstagflation, an economic no man's land where prices soar, growth stalls, and the middle class is systematically squeezed into extinction. This isn't theoretical anymore. It's measurable. Wages are flat. Core inflation is stuck above 3%. And real-world costs? They're exploding. The average basket of essentials has risen over 25% in just 5 years. Some categories are far worse. And while the official numbers try to downplay it, your grocery bill doesn't lie. This is where silver comes in, not just as an investment, but as survival capital. Because when inflation becomes embedded, when it becomes structural instead of cyclical, fiat currencies lose their power to protect value, and people start turning to hard assets. That's why Q2 2025 saw a 15% surge in silver ETF inflows. That's why retail investors are stacking coins and bars faster than dealers can replenish them. They're not speculating, they're escaping. What's fueling this crisis isn't just inflation, it's the failure to contain it. The Federal Reserve is paralyzed. Raise rates, and they risk detonating the $35 trillion debt bomb. Cut rates and inflation comes roaring back. So they do nothing, because they can't do anything. Meanwhile, your purchasing power erodes 1 month at a time. And as food, fuel, and housing costs march relentlessly higher, people are waking up to a brutal truth. The dollars they've worked for their whole lives are buying less, and less, and less. Macquarie says silver could hit $38 as stagflation deepens. But that's a conservative call. Because what happens when inflation expectations unanchor? When people stop trusting that prices will stabilize? That's not a market, that's a panic. And in that kind of environment, silver doesn't just hedge risk, it captures flight. It becomes the monetary alternative for those priced out of gold, but desperate to preserve their wealth. This isn't about theory anymore. It's not a macro forecast. It's a lived experience for millions. And in that kind of crisis, silver becomes more than a chart. It becomes a lifeline.
In debasing terms, going backwards on a number of levels. And it's worth showing you that. I'll just take the NASDAQ and I'll divide it by a currency. So your currency debasement has now caught up with the debt debasement that we first told you about when we've been interviewing for quite a long time now, 21, 22. I was highlighting about the turn at the end of the 2020 COVID markets, how debt went down. I was doing with my hands, then the fiat goes down. You're in the fiat debasement part because they Siamese twins. Money is borrowed into existence. You don't separate them. They conjoined at the head. The debt instrument crashes, the currency crashes, and so it is. They walk together. They don't separate, unfortunately. And when that is happening, your cost of living is going up. And I've been talking about a lady that she was an ex. She had a till slip from Walmart from 2020, and she filled the shopping basket with the identical items by weight, brand, and everything. And it cost 134% more, which is a 2.34x on what she previously spent. So in 5 years, she's claiming basic essentials. I don't think there was anything special. It was the same washing basket of items. She's claiming that they are more than going for 2.5 times more expensive in a 5-year period. This is your dollar-based debasement, and that's part of your reason why your gold has shot up so far, and we only see that getting worse. And if we do the NASDAQ adjusted for gold, just for that purpose, you've actually reached peak stock markets some time ago. You reached peak stock markets over here in gold terms in November 21. You're already in a turning market. Yes, you've had a bit of a bounce now. The NASDAQ has had a rally after an absolute crash, but that's reactional. This was the crash from here, and you went really far down in a very short time. It's natural to have a bounce back to this level, but you're back at resistance, and the trend is lower highs, lower lows, lower highs, lower lows. So, prepare for the next best thing. Gold is outperforming stock market. That's the fact. Regardless what I just said on the short, medium term that we could have everything sold off, gold will go down far less. The other key point, I want to highlight this. Bitcoin in the carry trade of last year in August fell 39%, I believe it was. It was either 30 or 39. So let's go with a smaller one, 30%. Gold didn't even manage 5% drop. It went down 4.7% in the drama of the carry trade unwind. Gold is still very good to hold in the downsides, and that's where silver hurts you a little bit, which is why I say have the mix, gold and silver, because the gold gives you a little bit of stability on there. No one cries too hard about a 4% correction. You will have, if you're in Bitcoin, have lost 30% in that period, especially if you were forced to panic sell or to buy items with it, it devalued. Silver fell higher amounts, but not as much as Bitcoin. So let me hand back to you.
They don't want you looking at the bond market. That's where the real panic is hiding. Because while stocks flirt with new highs and central bankers posture on stage, the global debt machine is cracking, and it's starting with the UK. 30-year gilt yields just hit 4.8%, brushing up against their 2023 highs. In the US, 30-year treasuries are hovering near 4.9%. That might sound technical, but here's what it means. Confidence in sovereign debt is eroding. And when governments lose that confidence, the fallout is always the same. Currencies collapse, inflation surges, and hard assets become the only safe harbor. The UK debt market isn't just a warning, it's a template. We saw this movie in 2022 when a mini-budget debacle nearly triggered a full-blown pension fund meltdown. Now it's happening again, only this time the stakes are higher. Fiscal deficits are entrenched. Rate hikes have boxed in policymakers, and central banks are running out of ammunition. The bond market is calling their bluff, and silver is watching from the wings. Why does this matter for you? Because debt crises don't stay contained. The moment one major economy breaks, the ripple effect hits everything. And silver, with its higher beta and volatility, reacts fast. Often down first in a liquidity scramble, then up violently as capital seeks safety outside the system. ING Bank is already forecasting a dip to $28 if the debt panic worsens. But they're also calling for a rebound to $34 by early next year. That's not a contradiction, it's a cycle. Pain, then flight. Suppression, then explosion. And here's the kicker. These disinflationary crashes don't actually fix anything. They just reset the board, temporarily. Because the debt remains. The deficits continue. And the only long-term solution is to print more, borrow more, and debase more. Which brings us right back to silver. Every bond sold, every budget busted, every bailout whispered into existence, it all adds fuel to the same fire. So when you see gilt yields spiking or treasury markets wobbling, don't tune out, tune in, because that's the sound of the paper system creaking under its own weight. And when it finally gives, silver won't just react, it'll detonate.
I tend to call them, in the individuals that make that up, actually get richer in hyperstagflationary environment, which is kind of a phrase we've coined to incorporate an extreme version of stagflation. Because everybody goes, oh, you mean like the 70s? We're going, no, it's not exactly like the 70s. It's worse. It's far more extreme, and the debt levels are much higher, et cetera, et cetera. You weren't at Reinhardt and Rogoff levels on the US debt to GDP in the 1970s. You weren't, the rest of the world wasn't so well coordinated and also at ridiculous levels during the time that America was, etc. So we've got a much bigger problem by geography and by debt levels at every level, hence the hyper. So we stagnate. Stagnation means wages don't move very far. You in real terms are going backwards. Financial repression is bond market chronically underperforms in real terms. So the yield being paid isn't sufficient and the capital valuations are going down or flat. So that means it's a terrible asset class to hold. And everybody realizes that. So bonds were very bad performers during the 70s. They're going to be even worse performers now. We've highlighted many times before with you how the TLT fell 55%. That's your bond market. That's your long-term bond market. 20s and 30s plus ETF of those debt instruments had lost 55% in the space of 4.5 years. Now you're going to have the currency debasement, and the cost of living aspect is going to make it very expensive for the blue-collar working class. They're going to get angry, because far more of their disposable income goes towards essentials. The middle class, it's suppressionist. They carry the tax burden. So part and parcel of the stagnation is there's a shortage of money and your government goes into tax scavenge mode. By the way, the tariffs are a tax that Donald Trump has introduced on the US citizen for his purchasing decisions if he decides to have anything that's made anywhere else outside of America, which invariably, despite being a big country that makes a lot of things, you do need a certain degree of imports. There might be certain specifications of goods you need to a certain standard that you simply can't get an American brand locally manufactured. In fact, you don't do much manufacturing anymore yourself like you used to when you were coming out of the war years. So you're not the same economy, you're not the same man, even though you've gone to the same place, it's not the same water or river that you're standing on. There's different H2O particles, and you're a lot older, not nearly as fit, not nearly as strong, not manufacturing any much the same amount that you used to manufacture post-war years when you were a juggernaut in truth, and really dominant in every way. So
something strange is happening behind the scenes, and it's not showing up in the headlines. While Wall Street fixates on CPI prints and rate forecasts, The real smart money is doing something very different. They're taking physical silver off the table, quietly, aggressively, and in volumes that should terrify the paper markets. COMEX silver inventories have dropped 10% year to date. That's not seasonal, that's structural. Physical deliveries surged 15% in Q2 alone, and the trend isn't slowing. India's silver imports rose 20% last year, with demand coming from both industry and private investors. Retail premiums are climbing again, and dealers are reporting delays. Not because of shipping issues, but because inventory is drying up. So what's really going on here? It's simple. Trust in paper promises is eroding. Investors are waking up to the difference between having exposure to silver and actually owning it. They're not interested in ETFs with counterparty risk. They're not betting on futures with rollover games and force majeure clauses. They want the metal, in hand, unencumbered. And they're willing to pay extra to get it. This is the unraveling of the paper illusion. For years, the silver market has operated on the premise that most investors won't ever ask for delivery. That the COMEX can roll, delay, or cash settle its way through any storm. But that premise is crumbling. With exchange stockpiles falling and physical demand rising, the system is approaching a tipping point. Here's the uncomfortable truth. There's not enough physical silver to cover the paper that's been sold. Not even close. And the more people who recognize that, the more metal vanishes from the system. This is how squeezes start, not with a bang, but with a slow, steady drain that becomes impossible to reverse. By the time the mainstream notices, it'll already be too late. The shelves will be empty, the premiums will be astronomical. And the price you see on your screen? It'll be nothing but a memory of what used to be available.
That's changed, and it's a hard pill to accept, especially when you're in the bar room swinging punches and you're telling everybody about your good years. They're behind you now in that sense as an economy globally, and there's downturn and real threat and damage to that. The opportunity, of course, is recognizing that and getting into the gold and precious metals, but hyperstagflation is going to bring an immense amount of distress and social unrest, and it's going to be encompassed in the social aspects are going to be encompassed in the financial reset, and they're going to present their solution, and then you're going to find out how that looks. And it isn't dandy. Inflation is a billionaire enrichment tool because they get to borrow real cheap, big corporates or big names, usually through entities, even though they're big owners. The individual as a big owner is not necessarily named on the loan because they don't risk their own names and things for bankruptcy. Tesla, for example, Elon Musk and the people behind him will have borrowed cheap. They will have got a lot of revenue from the state. And in actual fact, when the dollar loses value, their share price goes even more up because everybody needs something that isn't going down at the rate that we believe the dollar is going down. And so they get to billionaire class. The debt that they borrowed gets devalued. They were never charged high rates. They had possibly fixed deals or, some hedging strategies that mean that they don't suffer the downside, that the consumer products that are available for the everyday middleman who's an accountant, lives in a middle class area in America, has a nice 3-4 bedroom home, 2-car garage, but he doesn't have access to the same credit, the same terms, the same through an entity option. So it's an enrichment tool for the billionaire class. It's at the final phase of hollowing out the Gini curve, which crushes the middle, particularly in terms of West. They will carry the burdens of the taxes and takes the working poor and blue collar to the breadline. And that's going to cause a lot of angst, and it's going to be, they will be controlling the narrative, and they will divide and conquer as they always have done, turning blue collar against middle class man. And that's the social unrest part that should be a great concern. And it's all been orchestrated by state. Over expenditure of state is inflation. The proliferation of fiat is inflation. And what you're having is a cost of living crisis across the board that's going to be devastating for most working Americans, except the billionaire classes that own huge assets on cheap borrowing. That's the
Inflation is no longer a trend. It's a trap. And for millions of people watching their dollars buy less by the week, silver has become more than a hedge. It's a necessity. A lifeline. While central bankers debate theory, real-world purchasing power is evaporating. That's why retail investors are snapping up physical silver at a pace that's startling even the experts. Demand for silver coins surged 20% in 2024, and retail physical demand overall jumped 18%. This isn't about trading. It's about defense. What makes silver unique in this environment is its accessibility. Gold might be the classic inflation hedge, but for many, it's out of reach. Silver, on the other hand, offers the same monetary protection at a fraction of the cost. And the results are speaking for themselves. Silver has outperformed equities in real terms, delivering a 12% inflation-adjusted return last year. That's not a fluke. That's a signal. Investors are catching on. Aberdeen Standard calls silver one of the top inflation hedges in the world, targeting $37 per ounce by 2026. Even as mainstream coverage underplays inflation's impact, people can feel it in their daily lives. That's why ETF inflows are rising. That's why dealers can't keep inventory on shelves. And that's why the disconnect between paper price and physical price continues to widen. But here's the real kicker. This surge in demand is coming before the system breaks, not after. That's unprecedented. Historically, silver demand explodes after inflation panic sets in. This time, it's already happening. People aren't waiting for permission. They're front-running the collapse. They're opting out of a currency that's bleeding value and opting into a metal that doesn't play by central bank rules. And make no mistake, this isn't temporary. Inflation is embedded. The debt is permanent. And the people betting on central banks to fix it are running out of time. Silver isn't just keeping up. It's quietly building momentum for the kind of move that turns headlines into history.
To me, that's you have Palantir, the corporation that is receiving huge government status contracts from the Trump administration. That there's discussions with Shinbaum of Mexico regarding biometrics for the Mexican population and potentially the use here. Donald Trump, while he was actually dealing with Zelensky and Ukraine, actually got conveniently asked a mail-in voting question, for which he said he's going to stamp out mail-in voting and fraud, for which I think he's going to it'll be leaked that a biometric option for voting will be required, so they know everyone who votes. For example, in Australia, everyone has to vote, and it's controlled, and everybody is tagged for voting and participating. And I think what you're going to end up happening is you're going to get your biometric surveillance state introduced. So Biden shooed in all the immigrants and the criminals from the Latin American countries that were being shown the way to get onto the welfare tourism ladder in America. Trump, in the name of fixing the problem, waited for the reaction, anger, a lot of, crime, etc., brings the solution, the way we fix this, and you get the actual synthesis they always wanted, which means a further digitization of all your travel, passports, which will involve biometrics, face recognition, fingerprinting, and everything else. And now your question was around tokenization, so I've laid a bit of groundwork. Let's get to that. You'll find that a CEO of an asset management company is now turning into a stand-in CEO for the World Economic Forum at some place that was largely housed in Europe and held talk shops over there. So you can see how corporate entities with a massive quango that was started by Klaus Schwab with the help of Henry Kissinger, etc., is all part of your global governance, and are the people that are discussing plans, and we're the ones behind the thought paper, you will own nothing and be happy. How do they get you to own nothing, and how do they make you happy? I think pharmaceuticals for the happy side, although I think that's PR and propaganda. How do they get you to own nothing? They suggest that everything in terms of the post-collapse environment, which we are still to experience, we need a more equitable society, and we're going to go for this more Marxist technological vibe where everybody gets a UBI and you have a social score. And by the way, you need to register all your assets so that we can see who owns what. And once they've got you to do that biometrically, they can then start taxing people out of them, which will mean, for example, if they passed an unrealized capital gain on gold holders, we would be forced to sell some gold to make that tax payment. And they will weaponize the mass poor.
You can't talk about silver without talking about the gold-silver ratio. Right now, it sits around 80 to 1. That means it takes 80 ounces of silver to buy 1 ounce of gold. Historically, that number hovers closer to 60. And when silver is really undervalued, like now, that ratio has been known to plunge fast. During major bull markets, it's not uncommon for that gap to shrink to 40, even 30. What does that mean in plain terms? It means silver has a lot of catching up to do. This isn't just a fun statistic for precious metals nerds. It's one of the clearest signals that silver is still flying under the radar. In Q2 2025, silver outperformed gold. The ratio narrowed briefly, but now it's widening again, mostly because traders are crowding into gold as a safe haven, ignoring the fact that silver has both monetary and industrial drivers behind it. That's a mistake, because when the metals really start to run, silver always follows gold, and then it leaves it in the dust. Analysts at BMO see this coming. They expect the ratio to tighten to 70 by mid-2026, driven by silver's industrial surge. Others are even more aggressive. Historically, when the ratio breaks hard, it doesn't just drift lower. It collapses. And when that happens, it's not silver lagging gold. It's silver going parabolic. Let's be clear, this ratio isn't just academic. It's a pressure gauge. And right now, it's flashing undervaluation in neon. It's telling you that silver is still cheap, still unloved, still misunderstood. But that window is closing. Because as institutional money flows into gold and retail stacks physical silver, the market won't be able to maintain this imbalance. So watch that ratio, because when it moves with force. And history shows us what comes next. Silver doesn't just catch up. It overcorrects, it overshoots, it explodes. And by the time the ratio reverts, the opportunity will be gone.
Which will be 90% of the population, unfortunately, to say these guys that were, hodling their pet rocks have done real well at your expense, and we can't build the airport because of them. It's time we think the unthinkable and have a wealth tax, and, all of this, we'll build back better together, all the catchphrases. We'll get to, and we're all in this one together, solidarity, which is a very Bolshevik communistic term. So I think they move us into tokenization of assets first, where you're obliged to register. Otherwise, there's fines, there's threats of prison, various other ways. This could set up either confiscation, and if that's too outright dangerous, taxation, where you become a forced seller of the asset that they want to eventually own. Till eventually, when you buy a house, all your paperwork and potential rental agreements and documents will all be held up in the blockchain, in the cloud, basically, and someone else who bought your NFT that represented your house could then trigger a rental agreement on you, on your property. And we all have to be this Airbnb existence where you just rent whatever you need wherever it is. And that's why they're such fans of these driverless cars, batteries, and various other things. Now, it sounds far-fetched, and many people watching this will say, I'll never go along with it, and I'll never let it happen, and they won't win, and I've got guns, and all the other typical responses that I'm so used to hearing. And I just point you to CV19, and you look at how many people complied, how many people died, how many people followed, how many people really lost their jobs because they refused on principle. They were a very small minority, and they can nudge, they can media splain, they can do a lot of things that could be very, very damaging. So just buying your gold and silver is part and parcel of securing your balance sheet. You need to be in a community, you need to be self-reliant, you need to get away from states as possible. To most Americans, because this is a Western attack vector, I encourage them to have options outside of the West as a right of residency and other places that they could go, because I feel that the living standards of the Western man and woman, of course, are the ones that are outlier high and are coming to be crushed. And BlackRock, Blackstone, and Palantir type corporations that are corporate fascists working with states against you, you don't undermine these corporations enough. You should demand their breakup. You should demand far more investigation. You should ask why their boards aren't diverse when the companies that they own, they forced all these inversion, perversion rules on you during the Biden era. So there's a lot of work to be done in fighting back. And at the moment,
The industrial story behind silver is no longer a subplot. It's the engine, and it's running red hot. In 2024 alone, industrial demand hit a record-breaking 710 million ounces. That's not investor hype. That's real-world usage. Silver is no longer just a monetary metal. It's a foundational input for the modern world. And as the green revolution accelerates, silver isn't optional. It's essential. Start with solar. Photovoltaic demand has exploded, 210 million ounces in 2024, and projections show it blasting past 250 million within just 2 years. Why? Because silver is the most conductive metal on the planet. And every single solar panel from rooftops in California to mega farms in China needs it. Thrifting tech might reduce the amount of silver per panel, but it can't eliminate it. And the sheer scale of solar build-out dwarfs any savings. More panels means more silver, period. Now add in electric vehicles. In 2024, China's EV production jumped 15%. Each vehicle is stuffed with silver: batteries, sensors, circuit boards, inductive chargers. This isn't some future bet. It's now, it's happening, and it's accelerating. Samsung's upcoming solid-state batteries may push silver usage to an entirely new level, up to 1 kilogram per vehicle. One car, 1 kilogram. Then factor in AI infrastructure, 5G expansion, robotics, smart appliances, all using silver in switches, connectors, relays, and signal processors. We're entering a world where every intelligent device requires more embedded silver than the one before it. And no substitute comes close. Analysts at Metals Focus are already projecting industrial demand to reach 750 million ounces by 2026. That's up 8% in just 2 years. But the mining industry? It's flatlining. There is no production miracle on the horizon to meet this surge. The math is brutal. Exploding demand plus stagnant supply equals vertical price pressure. This is the silver story most investors are still sleeping on. They see the metal as old-world money. They don't see the solar panels on their neighbor's roof, the EV in their driveway, the AI server farms humming under their city. But when they do, when the industrial reality collides with the investment narrative, the revaluation will be swift and total.
Permission, more force. So some people there might be a higher tendency for people to display skepticism, but I'm afraid to say I don't think that goes up hugely. I think it goes up a bit. But what they will do is they'll have ever more powers. What people aren't noticing is and I don't know either, but the people that do look into this tell me, your Genius Act, your Patriot Act of post 9/11, your Genius Act and Big Beautiful Bill, these papers that are being passed are absolutely draconian. Now, I think America stayed out of the new WHO agreement, which is 1+, but most nations have been captured by the new World Health Organization agreement signatures that were made, signed up. And that gives states full right of force to bring in medical interventions on people that would actually change how things are with CV19. Literally, a SWAT team and a nurse could technically show up, and you could be denied all sorts of things. So, I mean, that is brutal, and it's communistic. The concept of self-determination and self-reliance is under attack. Privacy is under attack. And you don't resent your government enough, and there should be far more consequences for captured governance. You really need to have a look at who's getting away with murder and who's allowing that to happen, and you need some serious pushback against your local politicians who comply with that and get corrupted and become national politicians, because from the top down, it's pretty filthy government. All through, and it doesn't matter Democrat or Republican. So sorry for the Trump friends and the Biden. I've no dog in either fight. They're filthy, all of them. They're corrupted and they're filthy, and they're selling you down the river. End of story. And you really need to there needs to be adverse consequences for these people that are co-opted against the citizens and go and do things for a bit of money for themselves, and a rope around all their neighbors and citizens. It is a battle of good and evil, but unfortunately, God helps those who help themselves. You need to push back, and there need to be consequences. Justice is not anti-Christian. and is not anti-godliness for people that are doing nefarious actions against the populace and citizenry. And my argument is that the governments have got too big and have stopped fearing citizens, and citizens now fear government. And that is very wrong, and it's gone way too far.
Here's the dirty secret the mainstream won't touch. Silver isn't just in short supply, it's structurally scarce. And the production side? It's broken. In 2024, global silver mine output was just 820 million ounces, down from the prior year. That's not a blip. That's a crisis hiding in plain sight. Demand is pushing past 1.2 billion ounces annually. Do the math. The deficit is baked in. What's worse? Most silver isn't even mined for its own sake. Over 70% of global production comes as a byproduct of other metals like copper, zinc, and lead. That means even soaring silver prices won't magically create more supply. Unless those base metal mines expand, and many are actually scaling back due to cost pressures, silver output stays flat. Or worse, it falls. In Mexico, the world's biggest silver producer, 2024 saw a 3% drop in output. Labor disputes, environmental reviews, and government red tape are choking projects. And that's just one country. New discoveries are rare. New projects? They take a decade to permit, build, and produce. By the time new supply arrives, this bull market may have already peaked. Meanwhile, the above-ground supply is draining fast. COMEX inventories are down, ETF holdings are sliding, and the Silver Institute confirmed it. 184 million ounces short in 2024. That's 4 straight years of deficits. CPM Group thinks 2025's shortfall could hit 200 million. This isn't speculation anymore. It's structural imbalance. And then there's the manipulation layer. Paper silver games may suppress prices for now, but they can't conjure physical metal out of thin air. Eventually, reality breaks through. When buyers start demanding delivery and the shelves are bare, the illusion cracks. And when that crack turns into a break, prices don't rise, they slingshot. This is the part of the silver story that Wall Street doesn't want to see. Because if the world wakes up to just how rare this metal is, how irreplaceable and underproduced, it's game over for the suppression games. The reset isn't coming. It's already started. And the supply side won't be ready.
Should be readily searchable on this database, by the way, which, funnily enough, Palantir and Peter Thiel and all his friends right the way to Tel Aviv can all investigate at any time, and your own personal security cameras can be hacked into from the Wi-Fi so they can look at their future home, and all of this is going on. Even if you've gone rural, you have a farm and you've got a few friends on a farm and you've all got a couple of acres each and you all got each other's back and firearm to the hilt and ammo and cans of beans. If you are told to pay your property taxes, and this is the system that you must have, and you have to register on XYZ app that links into the blockchain and also has all of this, and if you're out of the system, you can't do it. It's going to be very hard long-term to stay in a manual system, manual conveyancing environment when they use squeeze and technology to push you out of it. I mean, think how we used to get our milk with milk coupons dropped off by a battery cart and all of that. Nobody does that anymore. They taper us out of old things. Now, I'm not saying a battery milk cart was necessarily a thing worth retaining, but in terms of registration of property and everything, they'll find the weakness in self-serving communities. And it's very interesting how the Mormons and the other communities that are very strong and conjoined and have resisted technology, I'm thinking, help me with the other word, the Amish, are going to be handled in terms of this, because I don't think they want to make too many exceptions for anyone. But they don't have much autism. They've resisted the technology and medical interventions, and I wonder at what point they try squeeze them and what their reaction will be. Might be time to have, if you are to stay in America, to have your property close to communities like that and be kind, friendly, value add towards them and a good community member, and work together with them as closely as possible if you're thinking of seeing this out in the United States.
Fantastic. Well, Francis Humphrey, really appreciate your time today. As always, if people are interested in learning more, they can go to themarketsniper.com. You're also on YouTube. Can you tell us a bit about that?
Yes, sure. Our primary goal is that this is a unique time. This is a reset. By the way, all sounds so doomer, all sounds so negative. It's an interesting life. You didn't ask and you didn't vote for a boring life. You asked for an interesting one. You were chose to be here in this time. This is your goal. This is your interesting race that you're going to run. And you can just play the hand you're given to the best that you can. And that involves taking action, being positive, keeping fit, being an inspiration to other people, giving value to other people, being a good human, being someone of principle. And we intend to help people build wealth, because unfortunately you do need to retain wealth during these times. It is a mechanism for transacting, preserving that wealth, and having optionality on your freedom, the three key points, so that you could have an existence, possibly in a different country, different state, etc., if things went particularly bad in your area, but also retaining your wealth through an environment where hyperstagflation is almost assured and the cost of living is going to go up immensely. And there may be a lot of social discontent during that period. That's our core focus, the financial element around that.
Look at the charts. Look at the data. Look at the trend. Silver isn't just moving, it's awakening. After a decade of dormancy, the metal is tearing through resistance like it doesn't exist. That $34 ceiling from early 2025? Gone. We're now in the 40s and holding. Technical analysts are calling it a confirmed breakout. Fundamental analysts are calling it a structural re-rating. But those who understand what's coming, they're calling it the beginning. Because this isn't just a price move, it's a paradigm shift. Industrial demand is setting records. Supply deficits are deepening. Paper inventories are shrinking. And global confidence in fiat is cracking. Silver isn't rising because of one event. It's rising because every system that's supposed to suppress it is failing. And the smart money knows it. The gold-silver ratio is still historically high. COMEX is leveraged to the edge. Central banks are scooping up gold, and silver is riding the wake. And as the Fed prepares for more rate cuts, the floodgates could open. This isn't a moonshot. It's a repricing, a return to reality after decades of distortion. So forget the noise, forget the manipulated dips. The path ahead isn't linear. It's vertical. The next leg isn't just possible, it's inevitable. And as silver breaks into a new market regime, one thing becomes crystal clear. The era of cheap silver is over.